What if I told you a boring metal just went from $30 to $121 and then crashed 36% in a single week? Most people ignored it, but what just happened in silver could be setting up the next big move and almost nobody is ready for it. You'd think I was talking about some meme coin or a speculative tech stock. But no, I'm talking about silver, and right now in April 2026, it's sitting around $77 an ounce, and the entire financial world is split into two camps. One side says it's heading back to $100, the other side says it could crash to $50, and in the middle of all this, JP Morgan just dropped a forecast saying, silver will average $81 an ounce for the full year. So who's right? Where is silver actually going? If you want real breakdowns like this, not headlines, but what actually drives the market, hit subscribe right now, because silver in 2026 is one of the most misunderstood trades out there. That's exactly what we're breaking down today in full detail. Stay with me. Let's start with the most important question. How did we even get here? Silver started 2025 at just $29 an ounce. Think about that. $29. By the end of 2025, it had climbed to over $70. That's a 130% gain in a single year. Look at this chart, it's almost a straight line up. Then in January 2026, it went completely parabolic, crossing $100 for the first time in history and touching $121.62 as its all-time peak, and then in one of the most dramatic reversals in modern commodity history, it crashed 36% in 1 week, from $121 down to around $75. The CME exchange hiked margin requirements, which forced leveraged traders to sell, and silver came tumbling down. Today it's recovered to around $77, and the question everyone is asking is, was that crash the end of the bull run, or just a brutal shakeout before the next leg higher? To answer that, you need to understand why silver went up in the first place, because it wasn't just speculation. There are real, deep structural reasons this metal has been on fire, and this is where things get serious. Here's the first reason, and it's the most important one: supply deficit. Silver has been in a global supply deficit for 6 consecutive years. That means every single year, the world uses more silver than it produces. In 2025, the gap was somewhere between 160 and 200 million ounces. In 2026, the Silver Institute is forecasting a deficit of 67 million ounces even, with supply hitting a decade high of 1.05 billion ounces. Here's why that matters. When you run a deficit for 6 years straight, you drain stockpiles. COMEX inventories, the warehouses where silver is stored for trading, are down over 70% since 2020. Watch this number. That's not a small thing. That's a physical shortage building quietly in the background while markets still price silver like nothing has changed. Now pause for a second, because this next part is important. Here's the second reason silver surged: industrial demand, and this is the part nobody is talking about. Silver isn't just jewelry and coins, it is the most electrically conductive metal on the planet, and the modern world runs on electricity. Let me simplify this. Solar panels use silver paste to capture and conduct electricity. In 2024, solar manufacturers consumed over 25% of the entire global silver supply. EVs use silver in sensors, wiring, and circuit boards, and EV-related silver demand jumped 20% in 2025 alone. AI data centers need silver for their hardware infrastructure. Every smartphone, every laptop, every electric vehicle rolling off the line uses silver. And here's the kicker: solar alone is expected to nearly double its silver demand between 2020 and 2030. By 2050, cumulative solar demand could consume 85 to 98% of today's known silver reserves. That's not a forecast for next month. That's a structural shift in the global economy that is already underway. So you've got 6 years of deficits draining stockpiles and industrial demand accelerating at the same time. That's the foundation of the bull case. Now let's talk about JP Morgan, because their $81 forecast is what everyone is referencing right now. JP Morgan actually revised their silver forecast upward by 44%. They went from predicting $56 per ounce all the way to $81. That's a massive change from one of the most respected banks in the world. Here's what happened. Watch these numbers. Q1 at $84, Q2 at $75, Q3 at $80, Q4 at $85. So they're not predicting a straight line up, they're pricing in exactly the kind of volatility we've already been seeing. Now here's what JP Morgan is worried about: 2 things. First, substitution risk. Solar manufacturers are already starting to use less silver per panel. Chinese companies like LONGi Green Energy and Jinko Solar are developing copper-based solar cells to replace silver. Shanghai Eiko Solar has already launched silver-free cells. If this trend accelerates, one of silver's biggest demand drivers gets weaker. Silver currently makes up 17 to 29% of the cost of a solar module. At these prices, manufacturers have every incentive to find alternatives. Second, no central bank buying. Gold has central banks as its biggest, most consistent buyers. When gold dips, central banks buy more. Silver doesn't have that safety net. So when silver falls, there's no institutional floor catching it. That makes silver far more volatile than gold. And this changes everything when we look at the bear case, because there is a serious bear case here and it deserves your full attention. JP Morgan's own analyst Marko Kolanovic has warned that silver could crash back to $50 if speculative positioning unwinds before the fundamentals catch up. ING has a 2026 average forecast of just $55. Peel Hunt is at $75. The Reuters analyst poll median is $79.5. The strongest argument for a crash? The Fed. Right now, markets are pricing in only one rate cut for all of 2026 and not until December. Silver is a non-yielding asset. When interest rates stay high, investors prefer assets that pay them something. A strong dollar makes silver more expensive for international buyers. Higher real yields make silver less attractive compared to bonds. Add to that the Iran war, which has created chaos in global energy markets and strengthened the dollar, which is directly negative for silver. And you can see why some analysts think $77 today could become $60 tomorrow. Now pause for a second, because here's the other side of this. So where does the $100 bull case come from? The bull case rests on three things happening together. First, the Fed eventually cuts rates, weakening the dollar and making silver more attractive. Second, China's export controls on silver, which began in January 2026, restrict supply and push prices higher. Third, the gold to silver ratio. Right now, gold is trading above $5,000 an ounce. Silver is at $77. Historically, silver trades at roughly a 60-1 ratio to gold. At current gold prices, that ratio implies silver should be closer to $83 to $90. If the ratio compresses further, which happens in strong precious metals bull markets, silver at $100 becomes very realistic. Gold-silver analyst Alan Hibbard has an even more aggressive view. He's saying silver could reach $175 or more in 2026, outperforming even its extraordinary 2025 run. His argument is simple: the market still hasn't fully priced in 6 years of structural deficits. The physical shortage is real, and when it becomes undeniable, prices don't just go up, they go parabolic. At the extreme end, Bank of America's head of metals research, Michael Widmer, has a 2026 target of $135 to $309 per ounce. Now that might sound crazy, and even he acknowledges it's a wide range, but his logic is based on historical gold to silver ratio compression and the idea that if investment demand accelerates, even modestly on top of industrial demand, the supply deficit becomes impossible to close without a massive price spike. Here's the honest picture when you put it all together. Silver at $77 today is already extraordinary by historical standards. A year ago it was $40, 2 years ago it was $25. The structural story deficits, industrial demand, green energy, AI, EVs is real and it isn't going away, but the short-term picture is messy. The Iran war is keeping the dollar strong. The Fed is not cutting rates anytime soon. Solar manufacturers are starting to substitute away from silver, and after a 36% crash from the all-time high, there are a lot of traders who got burned and are watching carefully before they buy back in. JP Morgan's $81 average for 2026 is probably the most credible, data-driven anchor you can use right now. It doesn't promise $100. It doesn't promise a crash to $50. What it says is silver has a solid floor around $70 to $75 based on physical demand and the likely range for the rest of the year is $75 to $90, with upside possible if macro conditions turn favorable in the second half. The path to $100? It requires the Fed to cut, the dollar to weaken, and one more catalyst, whether that's an escalation in supply constraints, a spike in safe haven demand, or China tightening its export restrictions even further. All of those are possible. None of them are guaranteed. Silver at $77 might look expensive to some people, but if the fundamentals we just talked about are real, this might actually be the early stage of a much bigger move, the kind of move most people only understand after it's already happened. If you want me to track this story as it develops through 2026, hit subscribe, because the next few months with the Iran war, the Fed decision, and China's export policy are going to be critical, and when silver makes its next move, you'll want to already know why. See you in the next one.